This video covers Chapter 17 for Principles of Accounting 2. Chapter 17, we're going to talk about cost accounting system. So cost accounting system is the method that we use to track our costs. We use this information to keep track of our inventories, cost of goods sold, and our period costs, so we can report those on our financial statements. We have multiple types of cost accounting systems. So we use them in all kinds of companies, manufacturing companies, service companies, retailers, to keep track of what our unit cost is for manufacturing a product or providing a service, and to help us plan and control cost within our business. The first costing system we're going to talk about in this class is called job order costing. Job order costing is used when companies have products or services that have individual components to them. The other main type of costing system that we'll cover in another chapter is called process costing. Process costing is used when we make multiple identical products. So when we manufacture hundreds to thousands of the same exact thing with no customization. So in job order costing, we're going to talk about individual jobs. So a job is whatever we need to fill a particular order for services or products, and we apply costs to each individual job. We consider jobs to be individual products for people. Some examples of companies that use job order costing are construction companies, movies, furniture makers, automotive repair, law firms, accounting firms, doctor's offices, dentist offices. And what job order costing looks in some of these fields, let's look at construction. So in construction, each construction project is a job, and the company keeps track of each job's costs separately. In the motion picture studio, each movie is a job, and we apply costs only to that movie. We want to know exactly how much that movie costs. We don't say, well, we made 15 movies this year and this was our total cost, so we're just going to average it all across all movies. We want to be able to know very specifically how much each item costs. Same with construction. If we're building two houses with a different floor plan, we want to know which costs go with each floor plan so we can make decisions about how much to charge a customer. When we're creating a job, we maintain a job sheet. So we prepare a job sheet for each job, and we record all of the costs for that job on that job sheet. Some companies use paper job sheets, some companies have Excel forms, some companies use QuickBooks and keep the information in there. There are a wild variety of accounting information systems that we can record our job sheets in. So this has an example of a completed job sheet. So we see that this is for a furniture company, and the order was for 100 dining room tables. So we made 100 dining room tables, and we recorded the costs related to that order of 100 tables. So we have two manufacturing departments. We have a milling and carving department and a finishing department. Each of those departments added direct materials to the job. They each had hours of direct labor. We can see milling and carving department had 700 hours of direct labor, and the finishing department had 300 hours of direct labor. And then we have manufacturing overhead. Manufacturing overhead gets applied to jobs. In this instance, The rate is 150% of direct labor costs. So what that means is we take our direct labor costs times 150%, and that gives us our overhead cost for that job. We're going to talk a lot more about applied overhead costs. So this allocation or application of overhead, we call it allocating overhead costs. We also call it applying overhead costs. So overhead costs, total overhead costs and our total units produced during the year are not always known. We get orders in for the entire year. So we need to make up a decision about how we're going to allocate overhead when we start our yearly process and use that system. Not all of our products or the services that we have consume an equal amount of overhead. We might have 10 products and each product uses our facility differently. So we've talked about the things that go into overhead, all of those indirect costs like salary, production salaries, factory depreciation, factory rent or factory mortgage, indirect materials, indirect labor. And so we have an expected amount of overhead per product or service helps us make decisions about whether too much overhead is being used in production. So we can evaluate whether or not we're putting too much overhead on products or services. We're going to go through some samples here, and then when you're in class, we're going to go through a lot of overhead examples. So how do we determine overhead application rates? We estimate based on what our budget says our overhead costs are going to be for the year. So we'll make a budget. We will predict how many units we're going to sell or produce throughout the year based on information, historical information we have. So we might say, typically in the month of January, we sell 5,000 units. So next year in January, we're going to make sure that we produce 5,000 units. But in February, some months, some years we've sold 4,000 and some years we've sold 3,000. So we're going to plan for somewhere in between that 3,500. And so we make our plans based on our historic information. We also estimate our overhead costs for the year when we make our budget. How much do we think production is going to cost? So we'll make budgets in a later chapter. So then we determine this overhead rate based on estimates. How we calculate that rate is we take our estimated total overhead cost and divide it by the estimated units in the activity base. If we have total overhead costs and we have one unit and we plan to make 20,000 units a year, then we would take our total overhead costs and divide by 20,000. Then every time we produced a unit, we would take that overhead application rate and apply to that. One of the most common units for applying overhead is direct labor. So let's say we're going to use direct labor hours to apply overhead. And in this example, we plan to have $100,000 in overhead for the year. And we plan to use 1,000 hours of direct labor. So we divide $100,000 by $1,000. And we get $100. So we say our overhead application rate is $100 per direct labor hour. So then when we make a product, if that product takes a half an hour of direct labor, then we will apply $50 of overhead to that product or job. So we take our overhead rate that we just calculated of $100 and we take it times the number of direct labor hours we assign to the overhead. So how we decide what we're going to use as an overhead allocation base depends on what drives the overhead cost. So we call this a cost driver. Our activity base, we call it a cost driver. So we use those base units. In our last example, it was the number of direct labor hours worked. And we decide what causes the most use of our overhead. Is it direct labor? Do we have a correlation between direct labor and the amount of overhead that we apply to our product? If yes, there is a correlation between the two, then direct labor is our cost driver for overhead. We can see some examples for cost drivers here. So historically, as I said, direct labor hours or direct labor costs were the primary driver of overhead costs. However, as factories become more automated, we tend to have a lot more machine hours, where the factory machines or robotic assembly is more a driver than direct labor hours. If we have a service, it might be how many hours that it takes us to do that service. For example, in law firms and accounting firms, it's common to bill per 15-minute increments. So we decide how much a person's salary is per 15-minute increment, and then we apply based on those direct labor hours. We can also have multiple overhead application rates. So this is called activity-based costing. Or we also have department allocation, task allocation, product allocation, procedure allocation, or activity-based allocation. They all use multiple allocation bases. In the first example we talked about, that was a single allocation rate. We took $100,000 divided by our 1,000 direct labor hours, and we applied it based on the number of direct labor hours each job or product used. With multiple overhead application rates, we would divide our total overhead into activities. And then we would say that $100,000, we can go back to the table. So we had a milling department and a finishing department. If we had different overhead rates for milling and finishing, that would be a multiple overhead rate for that company. If we said milling uses a machine, we use a machine to mill tables. So instead of direct labor costs, we're going to use machine hours to calculate the overhead application to milling. And finishing uses direct labor, so we're going to use direct labor to allocate overhead to finishing. And we're going to do a lot of examples in class because I know this is confusing. So how do we account for overhead costs? We have direct materials and direct labor and overhead. What goes into overhead is all manufacturing costs except direct materials and direct labor. Overhead is all of our indirect costs that cannot be conveniently traced to specific jobs or individual units of product. So we use this predetermined overhead rate to apply overhead. We keep this information in a subsidiary ledger where overhead is a control account. Which means at the end of the year, we will have underapplied or overapplied our overhead. Because we're using an estimated rate for the year, The actual costs that we incur during the year are often more or less than our estimate. At the end of the year, manufacturing overhead is considered a temporary count, which means at the end of every period, it gets closed. The overhead account gets closed to our cost of goods sold expense account in most situations. Exception to every rule and all of that. If we have a debit balance in the manufacturing overhead account at the end of the period, that means that we underapplied overhead. If it is a credit balance, we over-applied overhead. So we overestimated if there is a credit balance and we underestimated if there is a debit balance. So we need to close that account. If the amount is immaterial, we close the entire balance to cost of goods sold. That journal entry is whatever we need to zero out the overhead count. So if we under-applied overhead, over here, you see we under-applied, so we have a debit balance. That means to close that account, we need to credit overhead and debit cost of goods sold. The opposite is true if we over-applied overhead. Then we have a credit balance. So in order to close the overhead account, we need to debit overhead and credit cost of goods sold. If the balance is material, then we should divide it between work in process inventory, finished goods inventory, and cost of goods sold. If you remember from Principles of Accounting 1, what amount is material or immaterial is unique to each individual company. Connect will tell you what amount is material for a company when you have to make a decision about how much that is. Remember, $500 could be material to a small company, but not considered material to a large company. So Connect will tell you if an item is material or not.